Alright, today is Sunday, November 7th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, and let's dive right into it. In focus tonight, we're going to review the jobs report and the hidden facts because this so-called V-shaped recovery led by the Fed is leaving many groups behind, especially women. And rumor has it Jerome Powell has disappointed more women than Aaron Rodgers. And no, we're not talking about lying about the jab thingy. We're talking about the thingy. Anyways, we will also talk about the Pfizer pill and its impact on mandates. We will also talk about the options gambling mania and the risk it entails for the rest of the market, because for now, the market is heaven for market bulls, or shall we say market pigs, because bulls also make money. But with shorts becoming extinct species, there is no check on the market, and the conditions for market pigs feel like Colombia for Pablo Escobar's cocaine hippos, or the state of Oregon for serial killers. It's heaven. We will also talk about the announcement from the fraud father, the con man of the century, Reverend Elon Musk, who will sell at least 10% of his Tesla shares, and rumor has it the stampede to exit Tesla shares will produce more fatalities than a Travis Scott concert. Let's start right away with the jobs report. We got the number from the cooks in the morning on Friday, and the number is 531,000 jobs created for the public and private sectors combined. And here are the details for the number. Employers added nearly 120,000 cooks, and all of those, of course, in the Bureau of Labor Statistics. But we also added wait staff and other restaurant workers to help push the entire leisure sector up 164,000 jobs for the month. Some great recovery, right? We're adding cooks and waiters. Professional and business services added 100,000 positions, as management and technical consulting firms added nearly 14,000 jobs, and legal services rose close to 5,000. Transportation and warehousing, critical components of the U.S. supply chain, added a healthy 54,400 workers. And here are the details. We already talked about leisure, we talked about manufacturing, transportation, professional and business services, but we also added about 47,000 jobs in healthcare, 44,000 jobs in construction, about 35,000 jobs in retail, about 21,000 jobs in financial activities, about 13,500 jobs in wholesale trade. We also added 10,000 jobs in information, 4,000 jobs in mining, logging, and lastly 200 jobs for utilities. On the other hand, the government lost 73,000 jobs, and this is the second month in a row where the government loses tens of thousands of jobs. What's going on here, by the way? Is this due to the jab mandates? Is this due to government workers hopping to the private sector? Who knows? For better pay, maybe. Don't count on your beloved media propagandists to tell you the truth. Nobody's investigating why the government is losing tens of thousands of jobs. Now, when we visit the ice cream shop, all flavors are doing pretty good for now. The unemployment rate is down for white and it is down for Hispanics, and it remains steady for Asians and blacks. Be it the employment rate for blacks is higher than other groups at around 7.9%. Now, here's the problem, because when we look at the pre-pandemic levels, employment is actually down across all groups, but specifically women. For Hispanic men, the rate is down about 1%. For black men, it is down 2.4%. For white men, down 2.7%. All in all, we're down 3% from pre-pandemic levels. But it gets worse for women. White women down 3.6%, Hispanic women down 3.9%, and black women a stunning 5.3% loss. The silver lining is the unemployment rate for women ticked up higher in October. The problem is it comes at the expense of men. The unemployment rate for men went down in October. It has been trending down since August. So we continue to have a problem, a massive one, in the participation rate in this economy. Across all groups, the participation rate is down significantly from pre-pandemic levels. And of course, the propagandists at your beloved media outlets, they celebrated the numbers as an achievement for the Biden administration, of course. Here's a headline from CNN says, good news for Joe Biden. America is getting back to work. Really? Here's another headline from the New York Times. Pay attention, CNN. Workers quitting their jobs hit a record high in the U.S. in August. This is the finding from the jobs report that we got on Friday. But the New York Times is also involved in propaganda. They're the founding fathers of propaganda. The New York Times says the jobs numbers take the stag out of the stagflation scare. Really? We have your colleague at the New York Times just wrote we have a record number of Americans quitting their jobs. But I guess we're experiencing somewhat of a great recovery. You have an economy fueled by coke and fake money. Stimmies all over the place. Liquidity all over the place. What happens when the yayo fades away? When the stimmies are gone? When the liquidity is gone due to the tightening? What happens to this so-called recovery in this booming economy? One of two things. Number one, the entire economy reverts back to recession, aka a crash, or the economy slows down dramatically while prices continue to linger higher, and thus the stagflation scare. You geniuses. And here we have another genius from the New York Times saying American workers are taking home bigger paychecks. They are spending more for furniture, food, and many other goods and services. It is not yet clear which side of the equation, higher pay or higher prices, is going to win out, really? And this is written by the genius Gianna Smilik, who, by the way, has access to the Fed. But perhaps Gianna Smilik might want to dust her fancy NYU MBA because, really, you're asking which one is going to win, inflation or wages? The argument is already settled, lady. Long time ago, wages are now catching up with inflation after lagging for decades. The gap is so huge, we already know who won this one. Of course, it is inflation. For example, we have a state, Pennsylvania, that has quote-unquote embarrassing minimum wage of $7.25. Okay? So I guess we know who won that one, inflation or wages. Here's another fact for you, Gianna Smilik. Whatever your name is. Real wages actually went down since May 2020 due to rising inflation. Furthermore, the prices paid by consumers continue to surge higher and higher and higher, with no stop in sight, reducing the purchasing power of average consumers. Matter of fact, if we factor in productivity, the minimum wage in the United States of America should be $24.18 an hour. What are we getting paid? We're getting paid $7.25 minimum wage. No, not in Pennsylvania. In every other state. And the reason is, this is the inflation adjusted minimum wage. When you factor in inflation, the minimum wage is at $7.25. But Gianna Smilik says, I don't know which one's gonna win. I don't know if wages or inflation gonna win. I don't know what I studied back in NYU. What a bunch of geniuses. Perhaps you want to read the New York Times, Gianna, because here's another headline from your paper. Americans are flush with cash and jobs. They also think the economy is awful. Why do they think that the economy is awful, by the way? The psychological effect of inflation seem to have the upper hand. Yes, wages are rising higher. For example, airlines are jacking up wages to respond to the labor shortage. The problem is you have an entire industry that is getting choked by inflation. Jet fuel prices surging out of whack. Wages for flight attendants and pilots and technicians also surging out of whack due to the labor. And the response from airlines, of course, is to hike ticket prices significantly higher. For now, they have the pricing power. Why? Because we have the holiday season. People did not see family in certain instances for over a year now. So this will be the first holiday season with family. And therefore, they're willing to pay whatever price it is. The problem is, will airlines maintain the same pricing power as inflation continues to rise higher, as they pay more in wages, they pay more in jet fuel expenses? Will the consumer pay insane prices for tickets when they don't have to fly? So this is one industry on the brink of collapse. But here's the moral of the story when we talk about wages versus inflation. Which one is going to win? While wages are going up higher, prices are also going up higher at a faster pace, of course. We have other companies with the pricing power, unlike airlines. For example, Mondelez, the CFO says, don't expect relief from supply chain, inflation woes next year either. And we know from the call from Mondelez, they already raised prices higher and they will raise prices by a minimum of 7% higher next year. It will continue to go on and on and on. And here we have another propagandist, Stephanie Ruhle from MSNBC, who I like, by the way. The Bloomberg days, back in the Bloomberg days, she used to be a reporter at Bloomberg. But now she's a full-blown propagandist for the Biden administration. And her job is to put a lipstick on a pig. And it is becoming a little embarrassing here, Stephanie. She says there are tangible at Joe Biden White House accomplishments. Number one, vaccinations, 2 million to 200 million. I would argue the approach from the Biden administration caused a lot of vaccine hesitancy. We could have had better numbers without their aggressive, non-science-backed approach. But anyways, she says number two, jobs created 5 million. Let me fix this one for you. Jobs recovered in the leisure and hospitality businesses. We're recovering cooks, Stephanie. Number three, she says wages up $2 per hour. Wow, we're rich now. Wages up $2 per hour. Now do rent, gas, and food. And let's see how much of this $2 per hour will last. Then she says number four, Dow up 5,000 points. Wait a minute here. I thought your team is not the one who brags about the Dow and the stock market. You care about the real economy, right? All of a sudden, you and Joe Biden bragging about stock market gains. Let me break it down for you. The stock market gains are not due to Trump, are not due to Joe Biden. They're due to the cocaine from the Fed. The market is moving higher regardless of which administration it is because the stock market is different from the economy. The stock market is ruled by the Fed and the liquidity coming out of the Fed. Well, we now know that the liquidity is about to be tightened. What do you think will happen to all of these gains? She goes on to say wages are up, capital letters, and business is still booming. The argument that employers could not afford to pay workers more money was never true. It is harder for small businesses, which has motivated them to optimize operations. Also a good thing. Come on, man.
Come on, man.
You're putting a lipstick on a pig. You know it, and I know it. Wages are up. I just explained to you. Wages are not up. The minimum wage in this country remains at $7.25 adjusted to inflation. When she says small businesses, it is harder for them to employ workers with a higher minimum wage, yeah, small businesses are struggling to find workers, but she says that motivated them to optimize operations. Optimize operations like more than 50% of black-owned businesses, small businesses, mom and pops, may not survive COVID-19. We now know that at least 40% of black businesses, small black businesses, have collapsed. So what are you bragging about here, Stephanie Ruhle? Next, let's talk about this Pfizer pill and the optimism, the pill optimism, because the experts attribute the move on Friday in the stock market popping higher due to the news of the Pfizer pill. No, we're not talking about the blue pill. We're talking about the COVID pill. That's old news. The blue pill, that was the rally in the 1990s. Now we have another rally coming for Pfizer, at least, due to the pill. The problem is the news is already old. We already know that Merck has a pill. The difference is, according to Pfizer at least, their pill has an 89% success rate in preventing hospitalization and deaths. You pin that against the 50% reduction in hospitalization and deaths from the Merck pill, and therefore the stocks of Merck and Moderna crashed on Friday, while Pfizer stock exploded higher. Pfizer says the effectiveness of the COVID antiviral pill is beyond our wildest dreams. Keep juicing it. Now that you maximized the jab revenue, they want to juice you again with the pills. The entire country is owned by Pfizer. Just an FYI. Take, for example, former FDA commissioner, current Pfizer bitch, Dr. Shoe Polish Gottlieb, who every time they interview on TV, they have to hold their noses and say former FDA commissioner, current Pfizer board member. It feels like they're interviewing a hooker. Take a look.
Interesting action, Scott. I know you're not a stock analyst, but Merck immediately sold off about 4 or 5%. from this news, we know that the UK, I think it was just yesterday or the day before, gave authorization to use their COVID therapeutic. Does this, from what you can tell, and I know you're on the board of Pfizer, people say, do we ever disclose that? That's sometimes I think we don't have much time left for the interview. We disclose it so much.
Yeah, Dr. Gottlieb, did we mention to our viewers that you are a Pfizer bitch? Just want to make sure. And of course, the entire media apparatus is working as a salesman for Pfizer. Take a look.
Is brought to you by Pfizer.
CBS Health Watch sponsored by Pfizer.
Anderson Cooper 360. Brought to you by Pfizer.
ABC News Nightline. Brought to you by Pfizer. Making a difference. Brought to you by Pfizer.
CNN Tonight. Brought to you by Pfizer. Early Start. Brought to you by Pfizer. Friday night on Aaron Burnett Out Front. Brought to you by Pfizer.
This Week with George Stephanopoulos is brought to you by Pfizer.
This weather report brought to you by Pfizer.
Today's countdown to the royal wedding is brought to you by Pfizer.
And now a CBS Sports Update brought to you by Pfizer.
Meet the Press Data Download brought to you by Pfizer.
This portion of CBS This Morning sponsored by Pfizer.
On how to find the hidden sugars in the American family diet. Sponsored by Pfizer.
Even Big Bird is now a salesman for Pfizer, tweeting, I got the COVID-19 vaccine today. My wings is feeling a little sore. I don't know if that was Big Bird or Jim Cramer. I haven't watched Sesame Street since I was 8 years old. And guess who Sesame Street is sponsored by? Yep, you guessed it.
Pfizer. Pfizer brings parents the letter Z for Zithromax. More information about Zithromax is just a click away. Pfizer. Life is our life's work.
And now they want to jab the kids. Unfortunately, we have a lot of parents who are taking their kids, taking the selfie, look at my kids, they got jabbed, they're doing their patriotic duty to make more money for Pfizer and Big Pharma. And this aggressive media campaign have brainwashed, I would say, at least 50% of the population to become apologists and cheerleaders for Big Pharma. Yep, Big Pharma. You know, the evil Big Pharma? They managed to brainwash the population to become cheerleaders for Big Pharma, even though the risk for children is non-existent at all. The science says some 99.995% of the 469,982 children in England who were infected during the year examined by researchers survived, one study found. In fact, there were fewer deaths among children due to the virus than initially suspected. Among the 61 child deaths linked to a positive C-19 test in England, 25 were actually caused by the illness, the study found. So pretty much non-existent risk or threat for hospitalization or illness, but still give us our Big Pharma money. We want it here, and we want it now, and we want more and more and more. And here's a reminder, folks. According to the third quarter earnings from Pfizer, the company made over $14.5 billion from the jabs alone. This is an increase of 850% year over year in revenue. Without the revenue from jabs, the company did not grow at all. A tiny notch, that's all. But perhaps the most important economic question is, what are the impacts from the Pfizer pill on the mandates? Because we're seeing a massive failure here from these mandates. An unprecedented departure. Unjabbed workers face new challenge paying for their C-19 testing. And they are leaving their government jobs in droves. Over 70,000 jobs lost last month alone in the government sector of the economy. And the problem is getting worse. For example, we have thousands of intel officers, CIA, national intelligence officers, refusing the jabs, and they are risking losing their jobs. Now, the last thing that the Biden administration needs right now is a lack of intelligence. And even the so-called boosters, people don't want them. The reception is mild. Far fewer Californians getting the C-19 booster shots than expected, bringing new alarms. Of course, the news of the pill will reduce the number even lower. And the Biden administration is having tremendous problems with the jab mandates. More than half of U.S. states are suing to stop Biden's C-19 jab mandate. Matter of fact, the trucking industry dealt a crushing blow to the jab mandates from the Biden administration. Trucking industry hails huge victory after Labor Secretary says most truckers will be exempt from the Biden jab mandate. We're seeing a rebellion, folks, all over the country, from Boeing to Mercedes. A U.S. worker rebellion swells over jab mandates. Even companies in the private sector are now delaying their jab mandates. Take a look, for example, at American Airlines delaying employee jab mandates deadline until 2022 after Biden postpones deadline. And here it is, the final blow. Federal Appeals Court temporarily blocks Biden administration efforts to require workers at U.S. companies with at least 100 employees to be jabbed against C19 or be tested on a weekly basis. Gone. Poof. But rest assured, the White House says, stop calling it a mandate. This is misinformation. This is fake news. We're going to ban you from Facebook and Twitter if you call it a mandate. It is a requirement. It's not a mandate, it's a requirement. Again, with the lipstick on a pig, failure after failure after failure after failure, with no end in sight. Lastly, let's move on to the options gambling mania, because in this channel, I've been explaining to you pretty much every single day, with evidence, the so-called rally the market has been enjoying as of late is based on fugazi bases, on false bases, driven artificially via the options gambling mania. And now, even the mainstream media is catching up. Take a look.
The recent explosion in retail options trading appears to be driving some of the exaggerated moves that we've seen in some of these stocks. The moves appear not entirely to be part of just the short squeeze and the meme phenomenon and Reddit, but maybe also something to do with options. Take a look at 1 week charts of Avis and Bed Bath & Beyond. Both spiked. Avis jumping about 70%. Bed Bath & Beyond surged more than 70% in after-hours trading on Tuesday. Still up more than 37%. And even a chart of Tesla from last week when it joined the $1 trillion club still shows a 33% jump. For more on this now, we're joined by Gunjan Banerjee, a markets reporter at the Wall Street Journal's Money and Investing team, as well as a CNBC contributor, J.J. Kinahan, chief market strategist at TD Ameritrade. And you're well suited to this discussion, Gunjan. You have written about options extensively, and I intro the segment by saying, I get it, but I used to be in that business, actually, retail stock. It's always sort of been the tail wagging the dog when you see the underlying stock move based on what's happening from options. That's not what really is supposed to be going on. Options are very effective in doing a lot of things, but they're supposed to be based on the underlying stock. The option itself and activity there isn't supposed to dictate a tripling of the underlying shares. That seems like there's something amiss and maybe too much money around, or someone's gaming the system.
The headline reads from the Wall Street Journal, options activity tied to Avis, meme stocks explode. Avis activity hit the highest level in at least 3 years on Tuesday. Heavy trading continued Wednesday. And this is a phenomenon across the market, and we've seen this before. Last year, matter of fact, the so-called NASDAQ whale, remember that one? We now know that the so-called NASDAQ whale is actually SoftBank. They've been manipulating the market via options. And we all know how that mania ended. Tech stocks pulled back and they continued to consolidate. They did not move since that time for at least companies like Amazon, for example. And where is the SEC, you might ask? They remain in a coma. Who is behind this pump, this manipulation, this time around? The options gambling mania. They say it's retail. Retail are just going crazy. Really? Retail are going crazy? Gambling over $900 billion in notional value in Tesla options. They're playing with options in notional value more than they are shares of the company. The activities in the options market should track the activities in the stock market, not the other way around. But this is the extreme magnitude of this mania. Don't tell me that these are retail traders behind it. Yes, retail is participating after the fact, but who is the so-called whale this time around? This kind of activities of market manipulation via options always ends in a tragedy. We all know what happened last year when SoftBank manipulated the market higher. We all know what happened this year with Archegos, the disaster, the nuclear bomb from Archegos. Archegos was borrowing money. It's a family office, so there are no disclosures at all. We have no clue what's going on underneath the market, by the way. But here we have Archegos Capital, Bill Huang, who's gambling via margin on Viacom and Discovery options, call options, pushing these stocks out of whack. At the same time, the Chinese stocks that he owns got crushed because of the crackdown in China, TAL education, etc. The subsequent crashes in Viacom and Discovery happened because Bill Huang got caught with his pants down via margin calls. He borrowed a lot of money to YOLO Viacom. His Chinese stocks crashed. Now he gets margin called. And therefore, all of his exposure in Viacom and Discovery has to be liquidated to cover for the margin calls in the Chinese stocks. And that was a multi-billion dollars collapse in the stock market. It almost destroyed Swiss Bank and many other banks. It was almost a disaster, a financial disaster that was averted by a miracle. If we have somebody right now YOLOing Tesla stock higher or Nvidia stock higher via margin, and let's say they have exposure in Moderna, for example. Moderna crashes. Now all of their exposure in Tesla and Nvidia has to be liquidated to cover for the margin calls in Moderna. And when a stock like Tesla and Nvidia, these two giants are worth almost $2 trillion. If they crash together, you bet that this crash will not be averted. This market accident will be painful across the board, and it will not spare anyone. Is the SEC doing anything about it? Of course not, because the SEC remains in a coma. We have market historians and experts warning this is going to be history in the making in the next 3 to 6 months. A 48-year market vet warns of an impending 80% crash in stocks as soaring inflation will cause the Fed to tighten policy way sooner than investors expect. So you have the risk of a market accident via the options mania gambling. And now we have the Fed, another player, the most important player in the market, will get caught with their pants down, and they will have to tighten faster and more aggressively than before than expected to respond to inflation. The threats are looming, but are market participants even aware? Of course not. The 1929 stock market crash caught nearly everyone off guard. Are we headed for a similar fate? The answer is yes, 100%. That leads us to the poster boy of this bubble, Tesla, and the con man of the century, Elon Musk. After the massive pump in Tesla stock, which I believe driven by a certain whale, who knows who's the identity of this whale, but we now know that at least one Tesla executive dumped over $200 million worth of shares after the pump. We now know that the sibling of Elon Musk, Kimball Musk, dumped over $100 million in shares on Friday. And now we have Reverend Elon Musk himself asking Twitter, his cult followers, whether he should sell Tesla stock or not, 10% to be exact. And the results of the poll, you guessed it, yes, the culties are brainless zombies, of course. They're not even human beings. They voted yes, even though it's going to crash the stock on the top of their heads. And Elon Musk says, I want to sell 10% of my shares so I can pay taxes. Oh, really? Are we really that stupid to believe this garbage? Or isn't this the reality, Mr. Musk? What I tweeted last night? Reverend Elon Musk is not interested in selling his shares to pay taxes. He's been a freeloader his whole career. He wants to dump because he knows he won the lottery, and Tesla shares will probably never trade at this price ever again. Elon Musk paying taxes? Really? The man has not paid taxes for years. He's been a freeloader all along. For example, in California, we handed him the Fremont factory, which was owned by Toyota, by the way. We handed him that particular factory for pennies on the dollar, courtesy of the taxpayer, of course, because we believed in Elon. We believed in Tesla. Did he pay us back? Of course not. When the time came and California said, Mr. Elon Musk, it's time to pay your fair share. After all, didn't we help you build your business? You owe us something, a little bit of taxes perhaps. Did Elon pay? Of course not. He took his bags and he moved to Texas. And he scored billions of dollars in subsidies from the Texas taxpayer. And he's going to stab the Texas taxpayer in the back too. So give me a break. That Elon Musk wants to dump shares to pay taxes. Nope, he's dumping shares to exploit the mania and cash his lottery ticket. And of course, the Musks are not stupid. They know that the valuations are out of whack. They perhaps will never get this opportunity again to dump for hundreds of millions, if not billions of dollars. Because the bad news is mounting against Tesla, be it from the regulatory side, the investigation against the FSD program, or be it from the competitive side with Ford, VW, and other manufacturers squeezing in Tesla's game, or be it from the inflation side, forcing Tesla to jack prices higher and therefore reducing their market share. Matter of fact, the Tesla Model 3 now costs $8,000 more than it did back in February. And on top of that, we have more bad news for Tesla. For example, Apple already scooped Tesla executive, the software executive, to produce Apple's iCars. The Musk family looks at the stock, and they know that this is a once-in-a-lifetime opportunity to cash in billions of dollars of fake money, of stampede money, and leave the culties behind. Who cares? And here's your favorite, Meet Kevin, with a prediction, of course. Meet Kevin says, pure speculation, Elon Musk dumps 10% shares, leaves him with about $10 to $13 billion after taxes. Tesla falls after momentum dies, and Elon sails. When Tesla falls to a more reasonable level, say 20% down, Elon executes his purchase options at a lower tax liability. Rest goes into BTC. And I say Meet Kevin Paffarath is right, with a small exception, of course. Let's make a correction here. Let me fix it for you, Meet Kevin. Here it is. We're going to scratch out the rest goes to BTC thing. I don't think Elon Musk, who is a quote-unquote champion for the environment, is interested in investing for real in BTC, which pollutes the environment worse than big oil. Anyways, it is Sunday night after all, and I have a lot of things to do, and therefore we're going to skip to the charts analysis right away. Starting with the 30 minutes chart of the SPY, what do we have here? We have the gap and crap, followed by the bear flag. This is a bearish signal for the market. The fortunes will reverse from this point on, and my number remains 454. This is the support, and I believe the SPY will flush down to that level at a minimum. And then we have the daily chart for the SPY, the S&P 500, the futures chart, the continuous contract, of course. Again, the momentum indicators, the RSI, the MACD, all trading in la-la land. Of course, this is not a reversal signal. It is a sell zone. This is all what it tells you. It doesn't tell you to sell or to buy. It tells you that this is a zone where you want to take profits. It is a zone where you want to think about placing a short, because the market technicals are overextended. We know with the absence of shorts, no shorts available, the stock market is distorted. On top of that, we have market manipulation. The mechanics of the market are being manipulated via the options market. The options market mania, in my opinion, will frizzle out right away. Go back in history, not 20 years ago, just a year ago, to the SoftBank NASDAQ whale episode. That lasted for a week or two max before the entire market crashed right away. A lot of these NASDAQ names, by the way, remained in consolidation from that point on. These manias are extremely dangerous, folks. I wish you knew what the magnitude of danger from this options gambling mania is, mechanically speaking, of course. When we look at the chart, what's going on here? The candlestick patterns, we don't have a reversal yet. The volume continues to rise on the upside, and my target remains 4,549.5. And that would be a massive flush down. It's not going to happen in a day. It could, but the likelihood is it's not going to happen in one day. It will take a few days, and the market will flush down all the way to the support. The problem is we don't have a numerical number that explains to us how much of this rally was due to the options gambling mania. Is it 10%? Is it 20%? Is it 50%? If it is 10 to 20%, that's fine. The options gambling mania will frizzle out, and the chart that you see right in front of you will give up the gains that were based on options activities. If that is 10 to 20% of the move, it's not a big deal. If it is more than that, then we have a problem. And if it emerges into a margin call phenomenon, then the losses could be exaggerated by a lot. And here is the weekly chart for the SPX, the cash index for the SPY, S&P 500. We have a defined trading channel with peaks and valleys within the channel. We are now at the peak of the channel. The expectations are the chart should pull back from a weekly perspective. It doesn't have to go all the way down to the end of the channel, the lower end of the channel. This is a process that could take weeks. The problem is, what if we have a market accident? Because you combine the options gambling mania via margin with the possibility of Tesla stock crashing. We know if Tesla stock crashes due to insider selling by Elon Musk, that alone could exaggerate the move to the downside and trigger a lot of margin calls. And if that happens, then yes, the move to the downside will be exaggerated by a lot. It could pierce the lower end of the channel. Moving on to the NASDAQ, the Qs, 30 minutes chart. What's going on here? We also have the gap and crap followed by a bear flag. This is an ominous signal. You can look at it as a head and shoulder formation too. It doesn't matter. It is a bearish reversal signal. And the likelihood is the Qs will flush down big. The last support that I have is 372. We have a lot of so-called soft support at 390, 380, even 385, but these soft supports will not hold in a flush down scenario. The most reliable support is 372. When we move on to a daily chart for the continuous contract on the NASDAQ, again, the momentum indicators, the MACD, the RSI, highly extended, meaning that the pullback will result in a flush down because we're not extended by a little. We're extended by a lot, and we know from history the untangling of massive momentum moves in the market always result in a massive flush down. And therefore, we're looking at the support of 15,192. There is soft support at 15,600. That would coincide with the all-time highs, the previous all-time highs. But again, the most solid support at 15,000. If Tesla goes down, if Nvidia goes down, we get a massive problem here, folks. This could be proven one of the biggest bull traps in the history of this market. And here is a weekly chart for the NDX, the big NASDAQ. Again, we have a trading channel with defined peaks and valleys. We are at the peak of the channel right now. The expectations are for a pullback. Will the pullback be exaggerated by margin calls? If Tesla stock crashes, we'll see. But this is the risk you have to assume looking at this chart. Moving on to a 30 minutes chart for the IWM, the Russell 2000. What's going on here? We have a gap, but unlike the SPY and the NASDAQ, we don't have a gap and crap. We have a gap and hold, and the Russell 2000 has been outperforming as of late, at least the last few days. The news about the pill also supporting the Russell 2000, the reopening names, the cyclical names in the stock market to surge higher. Was it a knee-jerk reaction on Friday that will not be sustainable? We'll see. But for now, I have no reason to doubt the IWM, the Russell 2000. The candlestick formations are a lot better than the SPY and the Qs. When we switch to the weekly chart of the Russell 2000, the big one, we have a breakout out of a massive consolidation zone that's been going on for almost a year now. All of this energy has to be released one way or the other. And it appears for now that this energy is being released to the upside. I have no reason whatsoever to doubt this move, unless if this is proven to be one of the biggest and perhaps historic bull traps in history. But you also have to keep in mind that after the 2000 crash in the dot-com era, the Russell 2000 managed to outperform the NASDAQ. Yes, when the NASDAQ crashed, the IWM, the value name, got a smack on the face. Yet it was minimal, with very little damage. And the Russell 2000, the Dow Jones, even the S&P 500 managed to recover a lot better than the NASDAQ. The Russell 2000 outperformed the NASDAQ for years to come. So the question is, are we seeing the same scenario here or not? Let me know in the comments. And here's a chart for the dollar index. The dollar is popping higher. It couldn't break the resistance at around 94.7. We'll see what happens from this point on. The Fed is tapering. This is not a rumor, not a joke. It is actually happening, and this should support the US dollar higher. If we also have a sell-off in the stock market, this will exaggerate the move to the upside in the US dollar. And this will not be good or welcome news by our friend gold. Gold rallied higher on Friday on the heels of the massive flush down in the 10-year yield. We're going to talk about that in a second, but gold is rallying higher. Gold has three enemies. You already know that. One of them is yields, but the main enemy remains the dollar. If the dollar is trading sideways and the 10-year yield is down, then gold will shoot up higher. But if the 10-year yield is down and the dollar is popping higher, it will be extremely hard for gold to maintain any rally. However, if the rally goes on, the resistance for gold will be the same level of the three amigos. The support, if we have a flush down and a reversal of the latest move, as you might already know, 1,000. 685. This is my number. I will buy gold with both hands at that particular number. What about the 10-year yield? We had the head and shoulder formation, and now the chart is flushing down. We have negative divergences on both the RSI and the MACD indicator. Now pay attention here. This is important. The 10-year yield closed below 1.5% for the week. This is a massive ominous signal. The biggest debate right now in the financial industry is what's going on with yields. If inflation is rising higher, if the Fed is about to tighten and raise interest rates higher, shouldn't the 10-year yield pop higher? Why is it trading down? We debated this, by the way, at my work with economists who have a lot more experience than I do. The consensus is yields will pop higher. They will respond to the tightening. We might have some technical aspects right now, some foreign buyers buying bonds to respond to their own local economies. But at the end of the day, you're not going to be able to beat the mechanics of the market. When the Fed loosen their foot on the pedal of buying bonds, yields will pop higher. But you always have to play the devil's advocate. What is the other scenario? Because the ancient rule in the stock market is always trust the bond market. The stock market can lose touch, can reach mania status with no rationale whatsoever. But the bond market is much bigger than the stock market, and there is level of maturity in the bond market not found anywhere else. So whatever the market says, the bond market that is, you gotta trust the bond market. If we have an inversion in the yield curve, I'm not saying we're there, but if it happens, if we get close to that point where the higher end of the yield curve starts to trend down and does not respond to the Fed's tightening of the monetary policy, yet the lower end of the yield curve, we're talking about the monthly all the way to the 2-year yield, if those shoot up higher and we have an inverted yield curve, then what is the message from the bond market? The message simply is the Federal Reserve is in a tight spot between a rock and a hard place. You have two choices. Either you let this inflation go and you have a stock market that continues to perform, and you have an economy that continues to perform until it doesn't, and then you head into stagflation. Or you slam your foot on the brakes right now, you start tapering, and you start raising interest rates. And by doing so, you're gonna create a recession, because an inverted yield curve always predicts an upcoming recession. Perhaps the bond market is saying, Mr. Powell, you got two choices, both of them suck. Either you keep this inflation going until the whole thing explodes, a la the 2007 scenario, or you start tightening to respond to this inflation, and you're going to cause a recession, a la the late 70s, early 80s, and therefore the inversion of the yield curve. Both argument remains persuasive. Both arguments have a lot of legs to stand on. The argument that says in time the 10-year yield will pop higher and it will respond as expected to the tightening. Scenario number 2, the yield curve will invert in response to the tightening and the economy will head into a recession. So you have two choices. Do you want stagflation or do you want a recession? And again, both choices offer a dire outlook for this economy. Moving on to the TLT weekly chart. What's going on here? We have a closure above 149 for the week. We have a reversal in both the RSI and MACD indicators, the momentum indicators, and therefore the bear flag goes away. And if the TLT is about to pop higher and yields about to go down, this is not a positive signal, folks, that technology and growth stocks will outperform again. This is an ominous signal that this economy will head into a recession. What do you see right in front of you? Just the fugazi numbers from jobs and all of that due to the stimulus and liquidity. When that goes away, we're going to be left with higher inflation, meaning stagflation, and a significantly weaker economy. If the supply chain is not fixed, if the drought phenomena is not fixed, if the shortages in materials are not fixed, we're going to be left in a stagflation phenomenon, which will lead this economy into a recession. And therefore, the TLT, if it pops higher, it is predicting that we will see the rush to safety once again and the rush back to the bond market. The other argument says, watch out, yields will respond in time, they will pop higher. We are already at a bubble market territory in the bond market. When we talk about the hidden accelerator in the stash, the equivalent of what was happening in the housing market in 2007, 2008, which exacerbated the crash back then, our assumption, you and I, this time around, the accelerator is the crypto market or Evergrande China. And when these blow up, the entire market is going to collapse altogether. And this is the hidden accelerator. There is another argument that the hidden accelerator is actually the bond market. And when that bubble pops, the exodus, the mass exodus from the bond market will cause a massive economic collapse because interest rates will skyrocket and therefore the entire economy collapses, the entire stock market collapses, and we head into a massive recession, if not depression. The debate is fascinating. Both arguments have a lot of grounds, and it remains the number one mystery, the number one debate within the financial community right now. Moving on, the VIX 4 hours chart. What's going on here? We have a confirmation on the MACD that the VIX is about to pop higher. What does that mean? We have a confirmation that the SPY is about to weaken. The VIX is holding on the support of 15 beautifully, and now it is eyeing the 20 level of support once again. Moving on to Apple, what's going on here from a daily chart perspective? The bear flag remains intact, although Apple retested 150 for support and it managed to bounce back. So we'll see what happens here. But my assumption is weakness in Tesla and Nvidia after the frizzle out of the options gambling mania will impact Apple negatively. If the support of 150 is violated again, then you know that the bear flag is playing out. If the chart trades strongly, meaning maintains 150 as support, showing relative strength against the market, then you know the bear flag is not going to work out. Moving on to Tesla daily chart. What's going on here in the souffle? If the pullback happens, and so far, we don't have a confirmation from Elon Musk. It is absolutely stunning that the market, the entirety of the market, trillions of dollars at the behest and the mercy of one man, Reverend Elon Musk. We have enabled this monster to continue to manipulate the market up and down however he pleases. And the reason is the SEC remains in a coma. The SEC remains traumatized by the bullying from Elon Musk. Instead of doing their job and enforcing the law, they want to please the man. They want to say, you know what, Elon Musk, we're not really that mean to you. Come on, stop demonizing us. They want to kiss his ass and please him. And this is the result, of course. The entire market is at the mercy of Elon Musk. If Mr. Musk says, after careful consideration, I decided not to sell my Tesla shares, then the market will pop higher again. But if he does indeed follow up on the poll from Twitter, my assumption is he will, then it's not Elon dumping 10% of his shares. It's going to be other institutional investors and perhaps big whales from the retail crowd. We all heard the story of the Singaporean trader who made $7 billion. These big whales will start to dump because the Reverend himself, the cult leader, is dumping. If he's timing the top, then we're timing the top. And it is a great opportunity to book profits. The move to the downside will be exaggerated as a result. We have target number 1 at 900. Closing the gap. Target number 2 is going back all the way to the trend line, which will be about 36% loss top to bottom. Now, going back to the trend line, by the way, is not a death sentence for the shares. You're just erasing the latest mania. That's all there is. But Tesla will still be trading pretty much at the previous all-time highs, around 850, 900. When we get there to the trend line, we're going to reassess whether the stock is going to hold to these levels or are we about to see more losses. But isn't it peculiar that the stock shot up impulsively higher right before the Musk family decided to dump? Who is behind the latest options gambling mania? The SEC knows the answer, but they're not doing their job. Moving on to BTC tulips, what's going on here? This is a daily chart, of course. The tulip market has a lot of energy right now, and the energy drives from the assumption that BTC is an inflation hedge. And it will be an inflation hedge if all of us believe that it is. When you think about gold, for example, back in the 70s, is there any tangible proof that gold is actually a hedge against inflation? Of course not. But if the guy next to me and the guy next to him believes that gold is an inflation hedge, then it is an inflation hedge. And right now, this time around, if all of us believe that BTC is an inflation hedge, then it will be an inflation hedge. And we will see massive inflows in cryptos, but specifically BTC. Now, the wild card is, if Tesla goes down, let's say it goes down 10, 15%, how would that impact the shares of BTC? Is there any correlation anymore, or is that correlation gone already? And lastly, we're going to move on to the chart of AMC, 30 minutes chart. What's going on here? It is trading within range. The support 39, resistance 42.5. We have very important catalysts coming out for AMC this week, among them earnings on Monday, but we also have the news that AMC is getting into the popcorn business. Pay attention now. With movie theaters struggling, AMC is getting into the popcorn business. With the freak show that we're seeing in politics, for example, with the freak show that we're seeing in the markets, and perhaps the fireworks that are about to start in the stock market via crashes all over the place, perhaps the demand for popcorn will increase dramatically if AMC is getting into the popcorn business, and perhaps that will be the key for the stock to explode higher and force the short squeeze. You see? We're smart, right? Popcorn will become the most valuable commodity on the planet, and therefore AMC shares to the moon. Anyways, moving on to the conclusion of this video. What do we have on the earnings calendar this upcoming week? On Monday, we have PayPal, AMC, Cody, The Trade Desk, and Roblox. On Tuesday, we have Neo, Cisco, Coinbase, DoorDash, Wynn, Palantir, Unity, and Ring. On Wednesday, we have Wendy's, Dutch Bros, Affirm, Disney, and Bumble. Of course, I will do the earnings reviews from the past week. The video is already finished recording. I am editing it right now. It will be out as soon as tomorrow, probably in the morning. Again, apologies, but this is a one-man operation, so bear with me here. I'm going to get that video for you. I will get you more videos that I'm working on right now. Lastly, what do we have on the economic calendar this upcoming week? On Monday, nothing. On Tuesday, we're going to have the Producer Price Index. We will have the Small Business Index. This will be important. On Wednesday, the big day, we're going to have, per usual, the Initial Jobless Claims, the weekly claims, on top of the Consumer Price Index, the CPI, aka the CPLI. And the cooks, all of these hundreds of thousands of cooks that we hired, they're going to be extremely busy this week. They're going to show us that the CPI and inflation is actually a smaller problem than originally thought. On Thursday, we don't have anything here in the economic calendar. We have Veterans Day here in the United States. And lastly, on Friday, we're going to have the Consumer Sentiment Index. This is the preliminary reading from the University of Michigan. We're also going to have the number of jobs openings. And this will be important to pin it against the latest jobs report. Anyhow, folks, we're done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.